Good morning, good afternoon, and welcome again to the latest ADM Agriculture YouTube market update. Well, Happy New Year to everybody. I hope everyone's had a great festive break. Well, as we start the new year, well, we're actually looking at the same issues that we finished the previous one with: weather, geopolitics, and the impact of a potential global recession on demand. I think it's interesting to note that last night's close in Chicago wheat actually took the front month contract in Chicago below the level where it had settled on the same trading day in 2022, 12 months ago. So we've marched all the way up the hill and now all the way back down again, as the general situation from an S&D perspective now looks much more relaxed than it previously did. And certainly based on current estimates, there should be ample amounts of grain, either wheat, barley or corn, to meet global demand in the short term. And the outlook doesn't look that bullish without some unforeseen issue around production. The market, of course, is well aware of the issues in Argentina. La Nina, which has been impacting on their weather, is forecast to break sometime in mid-January, which will hopefully bring some rain and relief for the early corn crops. Conversely, the impact of La Nina in South America and Brazil has had the opposite effect to Argentina, and beneficial rains are likely to bring a bumper crop and potential record yields that could well offset any of the crop losses on corn in Argentina. This will, of course, be especially helpful for China, who have now signed a FITO agreement and are busy shipping significant quantities of corn from their new supplier. From a wheat perspective, Australia has enjoyed another bumper harvest, and they're all equally busy shipping grain to the Asian markets. Of course, we're aware of the political tensions that were there between Australia and Beijing, but for now, the status quo seems to be maintained and business continues, which is meaning that we're not seeing so much Chinese demand coming north into France or the Northern Hemisphere. Of course, the conflict in the Black Sea is still one of the most volatile issues for the market to deal with. Now, we saw a step up in the violence from Russia along the Ukrainian seaboard at the start of December, and this certainly impacted on the pace of shipments. But port operators seem to have been pretty quick to react to that, and generators were put in place, power was restored, and actually the total volume of grain shipped out of Ukraine for the month was the second highest of the season. There are still some issues getting grain out of the region, though, with slow customs checks in the Bosphorus. But despite this, the Ukraine continues to be a cheap seller into Spain and Italy, and Russia's bumper crop seems to be taking out any business for the Middle East and North Africa, again blocking European exports for now. You know, these exports into Span Med has some significant ramifications, though, for the UK. UK exports have limped to 700,000 tonnes for the first half of the season, leaving 1 to 1.5 million tonnes to go Jan-June. We really need to be cheap enough to go into the Spanish Med customers in order to shift this volume, but we're currently being undercut by Black Sea. We are seeing some interest to the near continent, North Spain, etc. But at the moment, we're probably a bit worried that we won't find enough business here to get rid of the surplus that we need, which could result in a big UK carry-out, as we're looking at pretty big wheat plantings after a really open autumn last year. So I think fundamentally things looking a bit more negative than perhaps they were a month ago. From a technical perspective, over that Christmas period, we saw the market bounce off the medium term and low at £237 basis, the May 23 ICE London contract. That rally in mid-December breached the previous overhead resistance at 247, but since the start of this year, we've seen a reversal of that, and we're now retesting the lows again. So I think in summary, we feel like this market probably has more of a bearish feel to it, certainly in the short term. Seasonally, January and February can be a challenge to find demand. And whilst I don't expect the market to plummet, it does rather feel like prices will grind lower through Q1. So there we go. Bearish start to the year really from here, but all to play for. And of course, we've got to get through another growing season, and there's an awful long way to go. Anyway, thanks again for listening. We really appreciate you tuning into our videos. And if you've got any comments, you want to get in touch and get any more information, please use the contact details at the end of the video. Thanks again.